Hey everyone, welcome to another video on my channel. My name is Saket and today in this video we are going to discuss why companies, in spite of beating their earnings expectation, the stock is falling. You might have observed this with the recent Q1 results. Stocks like Reliance, Infosys, TCS, Persistent, Bajaj Finance, all these stocks, in spite of reporting really good numbers which beat the street expectation, they ended up falling. So today we'll try to understand what are the three main reasons which actually cause this fall. So this video we are going to try to do it as a case study, try to take cases and try to understand why exactly the stock falls in spite of reporting better than expected numbers. Before moving on, I would like to tell you about two things. The first one is we have a free course on momentum investing which you can check out by going to QuickAlpha.in. We also have an exclusive workshop on momentum investing called as Learning Path. Here it is a 2-day workshop where we'll be teaching you systematic methods to develop investment strategies. So in case if you're interested, you can go to QuickAlpha.in to know more, or you can also contact the number given below in the description. And the next thing is on 9th and 10th of August, that is the next Saturday and Sunday, there is a Wealth Expo happening in Bangalore. So this is an event where thousands of traders are going to come together. So this is happening in Whitefield and I have attached the link in the description below with which you are going to get a free entry. So in case if you are interested, so you can definitely register for this Wealth Expo and attend it for free. With this, now let's quickly move on to the video. So when we take a look at this entirely, there are three main reasons why a stock generally falls in spite of reporting better than expected numbers. So we'll break down one by one. The first one is industry outlook and management commentary. So when you take a look at the current results, so current result is something of the past. So if the company is reporting a number today, that is of the previous 3 months and it is not about the future. But the markets look for the stock's future and not the past. It doesn't care what the stock has done previously, it only cares what the stock is about to do next. And this is where overall the industry analysis or the industry outlook with management commentary comes into picture. So let us take the example of IT industry. So most of the IT stocks like Coforge, Persistent Systems, TCS, Infosys, in spite of reporting better than expected numbers, ended up coming down. For example, when we take a look at TCS, the expectation was somewhere around 12,100 crores of net profit for Q1, but TCS came out with a net profit of nearly 12,700 crores. So by the matter of fact, it had beaten the street expectation. But when you take a look at it, it is not just TCS. When most other companies like Persistent also beat the street expectation, the IT as a sector overall is being hit down quite a lot. So let us try to explain why this might happen, right? So on one front, we are seeing what the companies have done previously. On the other front, we should also see what the management is expecting going forward. In this case, for example, if you take a look at the Indian IT service sector, it is all service-based sector. So unlike Microsoft or Nvidia or US-based tech companies, we don't have a solid product of our own. So for example, Nvidia makes chip, Microsoft makes softwares or they have a SaaS business. Amazon has AWS, right? So all of these have core products or core services which they are offering. But most of the Indian IT is basically service-oriented sector which service the big tech chains like Apple and Google. So they don't have any product of their own. Even though some of the companies do have core products, broad-based, it is a service-oriented business. So now with this new advent of AI, so slowly the tech job overall is actually under threat. Because if you take a look at it, today you can simply go to something like Claude AI and it can code the entire website for you depending on your requirements, right? So there are a lot of new tools coming with simple easy prompts. You can literally code the entire working website. So when I myself tried doing something with Claude, so I wanted to present an idea and I wanted a prototype of this entire idea. It literally coded for 40-50 minutes, thousands of lines, and now I have the entire JavaScript code with a fully working prototype. And I also use actively ChatGPT for most of the things when it comes to video related. And when it comes to other part of the work, I use ChatGPT very extensively. So this just goes to show that a lot of it, what a developer is doing today, can easily get replaced. So it is not long before this entire IT job is going to come to threat. And this same thing has been reflected with the management commentary of the entire IT group also, right? So they have already started laying off people. So actually tens and thousands of people are laid off across all top IT companies, including Microsoft, TCS, and so on. This just goes to show that the growth confidence going forward in the IT sector is not the same as before. So the first reason, or the broad-based reason, is how the outlook of the entire industry is. The second reason is the quality of the earning. So when you take a look at it, companies have something called as the direct income and the indirect income. So direct income comes from the core businesses, right? So for example, in case of Reliance, it's Jio, Oil, as well as Reliance Retail. So these three are the core businesses for Reliance. If you see Tata Motors, the core business is manufacturing cars. For in case of Dixon, the core business is actually manufacturing mobile phones. So each company has its core business, and they also have other incomes which they generate. In case of Dixon, it is, for example, the PLI scheme benefits which they receive. This way, there are many companies which do earn other income either by stake sale, either by one-off gains, or many such things, right? So what really matters is how the earnings is actually generated. So the stock might have actually beaten the expectation, but is the quality of earnings good or bad is what matters. So if the core business revenue is growing very strongly and it is still beating the estimates, so then the expectation is the quality of earnings is good. If the quality of earnings is good, then it is expected to do well, right? So in case of Reliance, this Q1, if you take a look at it, it beat the estimates by a big margin. But in this, most of the gains were from the Asian Paints stake sale which Reliance had actually done. This accounted to majority of the portion of why the earnings was actually beaten, or why the estimates were actually beaten. And that's the reason market doesn't really favor one-off gains, because they only come once a while and business overall hasn't changed in any particular way. Right? So this is a second reason, that is the quality of earnings. If the quality of earnings is good, so for example, you can take Eternal for that matter, even though the net profit was down, so the broad-based revenue generation for all its businesses like Blinkit, Zomato did really well. So the revenue estimates were beaten by a very big margin. And if you take a look at it, the revenue estimates were around 6,000 odd crores, but the revenue actually came in at 7,000 plus crores. So there was a huge beat in the revenue in spite of the net profits not matching up to the expectation, because the entire revenue came from the core businesses and the core business had seen a very strong growth. Market really likes it, and it rewarded the Eternal shareholders by taking up the stock nearly around 20% in 2 working days. So this is the second thing, that is the quality of earnings. And finally, the third one is the growth in most of the cases will already be priced in. So you might wonder, so why is the company falling in spite of the growth being coming at 60%, 70%. In case of Dixon, for example, last 2 quarters, in spite of company growing well over 100%, the stock price fell. And not just by a small margin, but fell massively. The reason for this is this kind of growth will already be priced in. For example, let's take BSE, right? BSE, if you take a look at it, April, May, June of 2024. So the company was having an average option turnover of 5,000 to 6,000 crores, or maybe it can be slightly higher, right? But today, the average daily turnover in options for BSE comes in to be around 14 to 15,000 crores. This is almost a 3x jump compared to last year. And the core business is expected to grow 3x because everybody knows that the turnover has increased. It is not going to be a surprise anymore, right? So looking at this, the stock has already run up. If you take a look at it, from the month of March itself, the stock has nearly doubled, right? So nobody is going to simply pay such high valuation unless you expect such kind of a growth. Now, in case if it comes in line with the estimates, so market is expecting a particular number and it comes in line with the estimates, market has already priced in the expectation. If not pricing in, nobody will move the stock price up by 100%, right? So this way, it is not just for this. Many other cases also you might have witnessed where the stock would have run up before the results. After the results, once it meets the expectation, you will see some kind of profit booking. This is a regular occurrence which is going to happen because you might have heard this saying in the market already, always buy the rumor and sell the news. So when something is expected to do well, so people will already start buying it and the stock price would have run up. And once it does well, there is going to be some kind of profit booking. So these are generally seen in all high growing companies, because if you take a look at it, they would be growing at a massive rate. The stock price would also be growing at similar kind of a rate. Now going forward, so I might be wrong, but the defense has seen a massive run up, expecting that the orders are going to go up drastically. So after the recent India-Pakistan war, so it is expected that all the defense companies are going to get large order books on defense. This would be already priced into the market. In case of BSE also, a similar thing would have happened. So the growth in BSE profit is already priced in. A similar kind would have happened with even companies like Dixon, right? So now this is the expectation out of the stocks. When the stock delivers, it will meet the expectation and a profit booking is expected. Broadly, when you look at it, there are three main reasons. One is the industry outlook and the management commentary, quality of the earnings, and the market already pricing in the stock move. So we will try to take some case studies and try to understand the industrial risk, how exactly things can look going forward. So these are some things which market really looks into rather than rewarding the past performance. Future is something uncertain and it mostly works on prediction. If you take BSE for example, the option turnover has already grown significantly. Now BSE and NSE expiries are changing. So it is going to shift on Thursday. BSE is going to shift it on Thursday. NSE is coming on to Tuesday. So NSE is going to get extra 1 day as expiry, which BSE has an advantage today. On top of that, SEBI is further trying to curb the retail participation. So they are trying to bring in fortnightly expiry rather than weekly expiry. That is a rumor going around. So these are some of the existing risk for BSE to continue its growth trajectory. So from now on, when you take a look at it, the stock has already grown 10x, or it has already grown nearly 1000% in the last 2-3 years. Can it continue similar kind of growth? May or may not, right? So it is already valued at 1 lakh and odd crores, and NSE is valued at 5 lakh crore. It is already 1/5 of NSE. 2 years or 3 years back, it was 1/20th or 1/30th of NSE. It has already seen a significant growth. So now, going forward, even though the company is beating the estimates for the next 2-3 quarters, will you see a similar kind of growth? May or might not happen. So in my expectation, it might not happen, but if it happens, it is really good, right? So a similar example can be taken in Trent. So when Trent rallied, right? So at one point, people were paying a P of nearly 200 for Trent, because the company had told that they were expecting a growth rate of at least 30 to 40% year on year in revenue. And markets also really liked it. They priced in extremely high. Later, the management came and told, okay, maybe this is a little optimistic. So we are expecting only 20%, and the stock price got punished really badly. So today the stock price is at something like 5,000, and a year back it was trading somewhere close to around 9,000. So these are some of the things which happen in spite of growing fast, beating the estimates. These stock prices sometimes fail to perform because they would have already run up. In no way this is an investment advice. I am not telling BSE is going to go up, Trent is going to go up, or they are going to fall, right? So these are just some of the point of view based on how it has happened historically. So even defense has run up, but what I am saying is not any kind of recommendation that defense has already run up, it is not going to go up further. Absolutely not, right? So I just want to use this video to give you an understanding or explanation of why exactly stocks might fall in spite of beating their quarterly estimates. I hope this video was informative and useful. In case if you have found value from this video, make sure to hit the like button, share this video, and subscribe to my channel. Thank you so much for joining, guys, and see you soon in the next video.